Hey, good morning.
Good morning.
That's bright and early today. I know you're super busy right now, so I really appreciate your time in doing this. I always appreciate your time doing this. But let me just
Absolutely.
introduce you real quick. So this is Two Mullins with Jet Home Loan. I'm Leslie Vitale with Keller Williams Realty. We're here in Northeast Florida talking about doing a little myth busting here on credit and kind of the number one killer of loan approvals. It's not your credit score. And also, people are underestimating or overestimating what credit score they need. So, let's talk about that a little bit and getting approved for mortgages.
Sure. Yeah, there's a whole lot of ways to go about it. If you're looking to purchase, there's lots most buyers have a lot of program options. Part of what pre-qualifying means is figuring out which ones work for a buyer, and more importantly, figuring out which one's going to give the buyer the most benefit. And so that's going to vary from situation to situation. It could vary based on the type of home they're buying, whether it's single family or condo or townhome or multifamily or whatever it is. So it's really important to kind of get there, figure out those details, and then pre-qualifying always is based on really three things: income, credit score. Credit score is going to tell us which loan program someone can qualify for, right? And then also assets. So the combination of those three things, someone's income to make the payment on the mortgage plus their other debts, someone's credit score to let us know which programs they can qualify for, and then assets, how much money someone has to invest, whether it be for down payment or closing costs or reserves or all three. The combination of those three things are going to tell us that someone is either pre-qualified or if we need to do a little bit of work or get a plan in place so we can get them pre-qualified.
One of the things that I love about working with you too, by the way, is you're sort of a master at working with endos to get somebody pre-qualified and getting them set up and teaching them, like some of the things because it's not just your credit score. It is the assets. It's how you manage that. It's how you manage the debt to income and all of that, and really working with somebody to get them ready to buy a house. You just don't go, well, not yet. Good luck with that. You get them ready.
Right. Yeah. Having a plan in place, it's going to help everybody, whether they're ready now or whether it is going to take a little bit of time, whether they're ready to buy today or buy in 2, 3 months from now. Everybody, it's stressful enough to buy a house and move and all those things.
Hmm?
Having a plan in place, it definitely will help kind of alleviate some of the stress and make it a lot easier on the person buying. So some of the things that get in the way
Yes.
or some of the obstacles, right? I'd say the biggest obstacle, probably for most home buyers, whether it's their first time or their 10th time, oftentimes it's the capital requirement, it's the down payment. That's kind of where people are at. Oftentimes, you kind of know what you can afford based on your income. You may be renting and know where you're comfortable at, just as a household with your budget, and you can kind of pare that part down. But getting there is sometimes one of the things that people want to think about and talk about. Um, Debt to income, um, just looking at what someone's income is versus their payments going out. It's easy to do that because we get a credit report and we see everything that's enumerated there and see what the payments are and just have to make sure that the new mortgage payment will fit within that.
And
But
what are we looking at for that? I mean, when you say debt to income, where should we be?
right. Well, I think when I'm looking at it really abstract and we're starting and we don't really know all the details yet, one of the things that the way I think about it is looking at what the gross income is and thinking about 50% of that and making sure that everything, including the mortgage payment, fits inside of that. If
Okay.
we're over that, we can take a look at it and see where it's at. But I know that if we're under 50% of the gross income for all payments, that we've got a really good chance to put something together that works. Now, what's more important than that even is then talking to the person to make sure it's comfortable for what they want to do and what their budget is, because there's a lot of things that don't go into that. Items that we said that are on your credit report, car payments, student loans, personal loans, all those things are obvious, but there's also other things like childcare, like utilities, like gas, insurance payments that don't show up on credit that
None of these
we're
things are
all
used.
making, right?
Yeah, I mean, insurance for the love of Pete. I
Yeah.
woke up about 6 months ago and thought I missed an insurance, car insurance payment and realized no, my insurance renewed and my insurance doubled. just overnight. Yeah.
There it is, right? So it's something that's not going to be necessarily credit related or on your credit score if you're looking at that to get qualified, but the buyer is going to know and feel that payment and know where they're going to be comfortable going forward. One of the new things that we see a lot, there's a lot of programs that are now buy now, pay later. A lot of
Klarna, like you're talking about Klarna and things like that.
Yes,
Okay.
yes. There's many companies that offer this now. Some of them are reporting on credit now, so we can see that on someone's credit report. But there's a lot of them that don't report on credit. And one of the things that is included in the underwriting process, we said we review assets, so we're looking at bank statements to make sure the money's in place. That's going to be needed for down payment and closing costs. Well, underwriting gets a little more forensic than that too, and is looking at recurring payments that may be on credit. And oftentimes, buy now, pay later programs, you'll see a payment. If we have two or three bank statement, you see the same payment coming out on the same day of each month for 2 or 3 months. That throws a flag up that, the bank's going to ask about and say, hey, what's that for? How long has that been out there? How long is that going to continue to be out there? Because that may not be on credit.
Okay.
And if it's something that's lingering out there, that may be something that we have to include in someone's qualifying ratios. And if something like that puts you over the top to where your loan no longer qualifies because you have, a few of these payments out there on items that have been purchased over the last couple of months, that could be something that we have to address and either have paid off prior to closing or paid off at closing to make the loan fit in the box the way that the bank needs it to issue an
See
approval.
people doing that with, well, with lots of things, right? But furniture. So those things can be longer payments. I mean, I do remember seeing a news article not that long ago about Uber was super excited that they had partnered with Klarna, so people could buy now, pay later for their lunch. The Uber drivers could do that. And I thought, well, that's probably not a good thing. That's probably super unfortunate. But yeah, so those payments can stretch out. It's not just like 3 or 4 months. It's not three easy payments necessarily. It
Right. Sometimes they can be longer, but regardless, the bank's going to ask about that if if we
okay.
see that as something that's recurring to make sure that we're not missing something. One of the disclosures that everyone that's buying a home receives too is to ask if they have any undisclosed debts, meaning anything that doesn't appear on credit. Sometimes that can mean something that you even financed last week or purchased a month ago that hasn't hit your credit report yet.
Okay.
We see that a lot with furniture. It can even happen with automobiles, anything along those lines. There's a list on credit reports that tell you when your credit's been pulled, inquiries in the most recent 6 months. So serves as a good frame of reference for the bank to see, okay, well, the credit was pulled here 2 months ago at Rooms to Go.
And y'all
Was
are
there a
going to
purchase?
check it again the day before closing, right?
It's
Most
going to be
likely.
checked. It's going to be checked before closing. Yeah, just kind of refresh just to
Yeah.
see,
So
not necessarily a full pull,
right.
but a credit refresh to see what balances may look like, or if there's anything that's there that wasn't there at pre-qualification or when we took an initial look a
Right.
month or 2 or 3
Importantly,
months ago.
yeah, and importantly to people, so don't go the day before closing to Rooms to Go and get roped into, hey, this is our sale, it's going to end today. Because if you apply for the credit and it's the day before closing and they look at your credit report the day of closing, but right before they fund, and you've opened new lines of credits, that could prevent you from getting your house. And I say that because I had that happen to a customer. This is not folklore. This is true. These things happen because people get excited. You just got to wait. The minute you leave that closing table, you can go do what you want, but you can't do it before.
Right. Yes. So you see a lot of things with other financial services like Zelle and Venmo and Cash App. Again, the bank's looking at the same thing. Sometimes you see recurring payments on the same day of the month for the same amount, whether it's to individuals or it's to,
Mhm.
maybe for a service or something like that. These are just questions that could come up that we have to do a little bit of digging on to make sure that there's not something there that the bank's missing.
Well, let me ask you too, by the way. So, like on Cash App and Venmo and PayPal, I actually keep a little bit of a balance in all of those. So, like if I've got a balance on PayPal, but I don't know, like my HBO Max or whatever they're calling it this week comes out of there.
Mhm.
Are you necessarily like, am I? if I go to apply for a mortgage today, am I showing that account? That do I need to show you my PayPal account, not just my bank account?
Well, potentially if it's something that's recurring, that's going to be extending. Yes, we could say, hey, if it's something that needs to be paid off, then that's where that statement could be called into question to say, hey, can you send that PayPal statement over to us? We can take a look at it.
Okay.
What tips the lender off is just kind of what's being seen on asset accounts like bank statements that are provided to verify for assets. Well, your bank statements also tell other tales as well, as far as what's going on with other financial activity, not just verifying and referencing balances
Hmm.
that are going to be used, but also, seeing determining what money can be used for someone that's purchasing. We've got to be able to source all the money that's coming in, and also want to make sure we understand everything that's going out to see if there's anything recurring that would need to be included in someone's qualifying ratios.
Fair enough. All right, so it's the number one killer of loan approvals. What are you seeing that's just killing people that's sneaking up on them that they're
I'd
not
say
really
I'd,
aware of?
I'd say what's sneaking up are things like this, like undisclosed debts. And that could mean anything like the buy now, pay later.
Hmm.
That could mean anything, maybe that is sometimes, you can find out someone has co-signed on an apartment for a family member or, something along those lines where they're helping a family member out. And then that can get called into question to say, okay, well, this payment's being made on this date specifically each month, it looks like from your bank statement
Hmm.
going to the same place that can uncover and unearth things. And I've had that happen multiple times where come to find out it's like, well, it was an apartment that I co-signed on for my parent that lives out of state because they, moved here or relocated and didn't have work yet set up. So we helped them get set up. And if, come to find out if a name's on that lease or there's some obligation that may not be on credit, that's something that we'd have to include in ratios. So it's
Okay.
better to know all of these things sooner than later, obviously, because surprises later kind of puts you under the time crunch as well to when you've agreed with your contract to perform and all of that. And it can, surprises like that late sometimes doesn't necessarily mean it's going to derail things, but it can complicate things and it can change things around. And again, we're already dealing with all the stress of relocation,
Hmm.
could be job moving, moving your family, the money. I mean, it's impossible for it not to be stressful, regardless of what someone's financial situation is. It seems like
Fair
it's
enough.
just the way that it is. So, like knowing all
Yeah,
the
even the most
input things.
straightforward one's going to be stressful. So,
Absolutely, yeah, it is. It's just a byproduct, right, of doing all that. So I say that because, knowing more of this up front, the sooner the better. Again, it can go into the plan with how we navigate that. When do we address it? Do we address it before going under contract? Do we know it's something we've got to deal with head on? Are there ways around it? Are there ways through it? Sometimes it just varies what it is, and knowing it is what's going to determine the best path.
it just kind of boils down to don't think that if you're applying for a mortgage, it do not think they're not going to ask these questions. So be
Right,
prepared to provide the documentation, and it's probably not a bad thing. It's just something that they're going to need to find out. It's not going to stay a secret. Just to
right,
put it up front, and then you can deal with anything. Because that's the thing. If there's not, if everybody knows about it, then it can be dealt with. It's not.
for sure.
It's yeah. I mean, and you're the master at that, which is one of the things I love about working with you. But yeah, like just let everybody know up front what they're going to be seeing. Okay.
Absolutely.
Next question is because we kind of talked about some of the killers that are sneaking in there, and I didn't even think about like Klarna and stuff. That's crazy because that's the only one I can think of. Is why I keep mentioning it. Um, But one of the things that people do overestimate is what their credit score has to be in order to buy. You don't need an 800 credit score to buy a house. So talk a little bit about that because I know people tend to think they have to fix all of that before they even talk to you. And that's not.
Right. Yeah, not always the case. There's certain things that I think the more tidy you can come into the situation, the better off you'll always be. But it doesn't mean that you have to come in squeaky clean or just, absolutely, in a perfect place to where it's going to be a slam dunk decision. Like we said, there's multiple programs that are set up for that reason. There's some maybe that offer more flexibility, some that offer less flexibility. It kind of always starts at what am I purchasing for? What's the reason I'm buying? Am I buying a primary residence? Am I buying an investment property? Am I buying a vacation property? And then we kind of go from there. The underwriting requirements are different for all three of those things. Am I buying them?
Fun if you're buying a primary residence. If you're buying
Yeah,
right, because that's
sure.
most buyers right now. That's what we're looking at is getting you into.
That's
So yeah,
right. So let's start there. We're going to get you into home. We're going to call this place our house. We're buying with the intentions of moving in at closing, after closing.
right.
So from there, where do we go? Well, we've got some options for that. Conventional loans, Fannie Mae recently changed its guidelines to where it had a very strict, line in the sand in terms of where the credit score needed to be for a long time at 620. That's no longer a hard requirement. They're kind of taking a more overall look at the situation based on total income, total assets, total credit, looking at the history and body of the credit to make decisions that are responsible and that, are going to put people in a good situation versus putting them in a bad situation. Government-backed programs like FHA and VA are traditionally known to be a little bit more flexible for credit scores, for credit history, and that sort of thing. Sometimes we have credit events that creep into place. Maybe you've had a prior bankruptcy. Maybe you've had a foreclosure or a short sale. So there's time periods that are out there
That are
that,
coming up again, which is killing me. So
yeah, they're kind of ticking up a little bit, right? It's kind of,
picking
but
up,
there's
it's about 2008 all over again. But yeah.
right. But so we throw all that out there to say, okay, it's okay if you've had all those things. That none of that disqualifies anyone from being able to purchase. So do you have to have perfect credit? No, you don't. There are ways to impact your score, whether your score is a little bit lower than it needs to be to qualify for a program. So again, that's something the sooner we can find out and address those things, the better off someone's going to be. Does that mean paying off debt? Does that mean maybe paying off or settling old collections that are in place? What types of derogatory credit are there from the past? And I say what types, meaning are we talking about medical, something that's very, I'd say relatively prominent with a lot of potential buyers? That's looked upon a little bit different than someone who maybe had a collection on their credit report for a prior apartment or rental that they were in. What's the amount that's outstanding? Are we talking about a couple of $100? Are we talking about several thousands of dollars? So the way that the bank looks at all of that are going to be based on, again, the specifics. What is it? When was it? How much is outstanding? A good line to take with collection accounts is to look at the total balance and factor in just 5% of whatever the total balance is as a monthly payment to see where the debt to income ratio lands. If it's in an acceptable place, that's something that we can hash out in underwriting and say, okay, we are factoring these items in. The credit score may still be in a place that's acceptable and the debt to income ratio works. Can we move forward or not? Oftentimes you can. Maybe it's something the bank says, hey, we need to address this. This needs to be paid off. If we can pay that off, we're in a good place and we can move forward. Can we pay it off prior to or at closing? And that's a lot of times how it shakes out and how you can take a situation that looks a little bit iffy and translate that into, getting someone into their home at closing a few weeks down the road or a month later or whatever it is. It's obstacles, again, derogatory credit, whether it's bankruptcy, foreclosure, collections. How do we address those? Factoring in what for collections, 5% of the outstanding payment. Maybe it has to be settled. Maybe it should be paid off. Is that something that you can do prior to going under contract if you know you want to purchase in the next 2 to 3 months? So
Mhm.
that's not even a conversation or something. It's a thing of the past when you're in process. Anything that you can do to kind of put yourself ahead, I think in that conversation is a good thing.
Right. So what that says to me, by the way, is call you because get in front of don't and it's hard. The financial thing I always say, put me in front of a room full of attorneys and I'm good to go. Like I can talk all day long. Put me in front of a room full of accountants and I'll crumble into a little ball. But like get get in front of you, let
Mhm.
you take a look at what needs to happen. Don't think you know what needs to happen. That's not your profession. Like, get in touch with your mortgage professional, let them tell you what you need to do, because no matter where you start from, you can end up as a homeowner. You just need a path, and let someone like you create that path for them.
Yeah, I wouldn't assume that that's going to automatically disqualify you or make it to a
Right,
point to where it's going to extend your timeline. Um, a lot of times, Leslie, it's not as bad as what people think.
right.
You know what I mean? Like it may have been a monster to you, or it's a bear to deal with, or whatever it is, and so you're kind of carrying that weight going forward. But when it comes down to it, you're right. It's just numbers, and it's like, okay, well, if we can address this way, and it's taken care of, and we can kind of paint the picture to where this works and is financially responsible to do, and it works for everyone, then a lot of times there is a path forward.
I love that. I absolutely love that. Yeah, and but to me, I guess the biggest thing is call you, get in front of someone who this is what they do, this is their profession, so that they can advise you. Because everybody's got, and I say everybody, I know people whose junk drawer in their kitchen is organized. I'm not that person. I will never be that person. I can assure you, housekeeping is just not the thing that I like to spend time on. And I am good friends with these people. Why they can put up with me, I have no idea. It's kind of the same thing with your financial life, right? Like
Yeah.
most people have their own mess. It doesn't preclude you from being able to buy a house. You just need to get somebody that can kind of organize that. I hate to call it a junk drawer because I realize what I just did to myself,
It's a
but
good
organize
analogy.
that junk drawer a little bit so that somebody can look and go, okay, that's what's here. We're
Yeah,
good. It's There's
right.
scary in there. We just need to know what it is.
Yeah. It's not as scary as people think sometimes. It may be to you, but like once you kind of start to kind of sift through, it's not that bad.
Yeah, well, we all like to hide the crazy, and the crazy, like that's the hard. I think that's the hard part for people to get about going through the mortgage process is somebody's getting into your crazy, and
Right.
and we all have it. That's the thing. It's not just new. It's never just you. I promise you, you're in the same boat as everybody else.
Mhm.
Let two piece it together and and get you into a home.
For sure.
Yeah. Well, that is awesome. All right. Any quick tips I mean, do you want to even do quick tips of what should somebody do if they know they're going to clean up a little bit? Like any easy,
Yeah.
like,
I think kind of like knowing it and kind of addressing some of this stuff on your own before going in is always a good idea. Does that mean like getting a free credit report of your own if you're not sure, if you haven't checked that in a while? Knowing where your score's at. I'm always a little concerned when we're just having a conversation like this, and if you ask someone, okay, do you know where your score's at? Have you checked it recently, or anyone told you recently where it's at? And I don't want to say it's a red flag, but it's a flag of some sort if someone has no idea, no clue. Like I'm always a little surprised at that, Do you have a guess, And I'll throw a range out, 500, 600, 700. And so kind of know, like
yeah.
have an idea of what's out there.
Oh,
And
question on that really, because
yeah,
I know as a realtor, you say the Z word and I go, oh God. For y'all, my understanding is you say the credit karma word and like you're like, nope, that is not really your credit score. Ta like
yeah.
is monitoring because that's kind of that's kind of like Zillow is I shouldn't say that the Z word is the verb is credit karma is kind of the verb when it comes to that, right? Like that's where people go check.
Yeah, it may not be, is he going to give you an exact tool if you go pull that and then I pull a tri-merge credit report? Are we going to have the same scores? Probably not. Very oftentimes when we pull a credit report, it's going to report a little, your scores are going to be a little bit lower than what you see on that.
Okay.
But I think it's a good resource for showing you what you have as open accounts, what the pay history is. If there's anything that you don't know is on your credit, that's a good way for you to see it. If there's a collection or anything derogatory there that you either know or don't know about. I think the more that someone knows about those things before going into the process, the better off they'll be. They'll be kind of coming in, on the right foot, just kind of having your own mind wrapped around what your own potential issues could be or your own concerns. You may see something on there that you didn't know was still there. You may see duplicate accounts. You may see a whole lot of things that you will be better off knowing than finding out later. So I would always recommend that just to kind of get a general frame of reference, especially if you know that there's something out there. If you know you're squeaky clean, you know you don't have any concerns. I've only had one or two accounts. Everything's fine. Everything's paid off. Haven't had any financial issues. You kind of know that's fine too. But if you think there's something that you should, if you're even thinking at all, get a free look. There's so many ways to do it. Your bank can offer a free credit report. I know Wells Fargo does. A lot of times credit cards will offer that. If you're a client to Chase or American Express or whatever it is, they'll give you a snapshot.
Mhm.
Take a look at that. It doesn't cost anything. You don't have to have your credit pulled to see that. And I'll say this too, just while we're speaking on credit, a lot of times I think there's a big misconception that even with us in qualifying buyers, that having your credit pulled is going to have some, this massive derogatory impact on your score.
Right.
And that's just not the case. When we're pulling your credit in conjunction with qualifying someone for a loan, is it going to be an inquiry? Yes, it is. And you should have that. Otherwise, one, a lender's not going to have really any idea of how to advise you properly, and not knowing. So we can have a general conversation about it, or we can get a more granular look with your scores and know where you're at, know if you're there already, or if we need to get a plan in place to get there. But it's not going to adversely affect your credit to where you were in a place to where you could qualify before, but now you're not. That's not going to happen.
And I get that question all the time. People are scared of that.
Yeah,
But that's an important
for
point.
sure. Yes.
All right. Well, so I feel like we had a pretty good chat about busting a little bit of myths here about, what you need for credit and what you need before you go apply for a mortgage, like, and dealing with professionals. So I love it. Thank you so much.
Absolutely. Thank you.
I appreciate it. I will.
Always
Merry Christmas,
discussion.
Happy New Year, all that good stuff.
Yes.
And we will circle back and have more to talk about after the first of the year.
That sounds great.
All
I'll
right.
see you then.
See you. Bye.
Bye.